Right now, while most people are arguing about politics, scrolling their phones, or deciding what to watch tonight, there's a number quietly growing that should stop you in your tracks. Not tomorrow. Not 5 years from now. Today, the United States is carrying roughly $38 trillion in national debt. That's not a forecast or a scare headline. That's what's already sitting on the balance sheet as of the end of 2025. And before you tune out because big numbers feel abstract, here's the uncomfortable part. This isn't just a government problem. This is a system problem. And the people who understand the system best are already reacting. Over the past couple of years, the largest financial institutions on the planet have started doing something they haven't done in generations. They're repositioning, quietly, methodically, moving massive pools of capital away from dollar-denominated assets. No emergency press conferences, no dramatic headlines, just filings, treasury data, and balance sheets telling a very clear story if you know how to read them. This isn't conspiracy theory territory. It's boring, documented capital flow. The kind that only gets noticed after the damage is done. By the time we're done here, you'll understand what's happening, why it keeps happening throughout history, and why the timeline matters more than the politics. There's a pattern to this, and it's not new. It's shown up again and again for more than 500 years. Same stages, same signals, same ending. The only thing that changes is the name of the country and the currency. Globally, total debt just crossed $250 trillion. That's roughly 235% of world GDP, the highest level ever recorded during peacetime. The United States alone added more than $2 trillion in debt in less than a year. That kind of acceleration isn't normal, and it isn't harmless. What's rarely discussed is that reserve currencies don't die suddenly. They decay in stages. And once the third stage begins, the clock starts ticking. Every major financial superpower collapse follows a remarkably consistent cycle. First comes the rise. A country becomes the center of a global trade and finance. Capital floods in. Its currency becomes the default for settling international business. Innovation explodes. Markets boom. Confidence becomes cultural. People stop imagining limits because they've never experienced them. That phase can last decades, sometimes close to a century. Then comes overreach. Success creates blind spots. Governments spend more because they can. Wars expand. Social programs grow. Political promises multiply. Debt rises faster than productivity, but asset prices keep climbing, so nobody panics. Real estate surges. Stocks hit records. Central banks step in to smooth over every problem with liquidity. On paper, everyone feels richer. This phase feels permanent while you're living through it. The third stage is where things quietly change. This is the part most people miss entirely. The public doesn't panic. Politicians don't warn anyone. Headlines remain optimistic. But institutional money starts paying attention to math instead of narratives. Balance sheets stop making sense. Interest payments grow faster than revenues. Risk stops being theoretical. So capital begins to move. Slowly at first. Pension funds diversify internationally. Sovereign wealth funds reduce exposure. Major banks rebalance portfolios. Wealthy families open accounts in new jurisdictions. Nobody announces it because they don't need to. They just move. This phase usually lasts somewhere between 18 months and 3 years. The final stage is when everyone notices. The currency loses trust. Foreign holders dump reserves. Interest rates spike. Inflation accelerates. Asset prices fall together instead of rotating. Banks wobble. Pensions shrink. The middle class absorbs most of the damage. Political chaos follows. The most common sentence you hear afterward is, "How did we not see this coming?" The answer is simple. The pattern was never hidden. It was just inconvenient. We've watched this exact movie before. In the 1500s, Spain was the unquestioned global superpower. Gold and silver poured in from the Americas in quantities the world had never seen. The Spanish real became the backbone of international trade. Madrid sat at the center of global finance. Militarily, economically, culturally, Spain looked untouchable. And because they felt untouchable, they spent like it. Endless wars across Europe, massive naval expansion, a sprawling bureaucracy, lavish royal projects. By the mid-16th century, Spain was spending roughly 3 times what it collected in revenue. The gap was covered by borrowing, mostly from foreign bankers who trusted Spain because, well, look at all the gold. Asset prices soared. Confidence was absolute. Then the smart money blinked first. Major banking families began shifting assets out of Spain. Creditors demanded repayment in physical gold instead of promises. Merchants quietly moved operations north. Interest rates on Spanish loans spiked to levels that screamed distress if you knew what you were looking at. Spain defaulted, then defaulted again, and again. The currency collapsed. Inflation crushed ordinary citizens. By the time the dust settled, the empire that once dominated continents was financially broken. The capital didn't disappear. It relocated. It moved to Amsterdam. In the 17th century, the Dutch Republic became the financial heart of the world. The Dutch East India Company was the most valuable enterprise in history. Amsterdam invented modern stock exchanges. Dutch banks financed global trade. The guilder became the reserve currency of choice. If you wanted to do international business, you needed it. Sound familiar? Then came the wars. Expensive wars. Government debt exploded. Money printing crept in. Asset bubbles formed. Tulip bulbs sold for the price of houses, which is funny until you remember every generation has its own version of tulips. The Bank of Amsterdam, trusted as the safest institution in Europe, quietly violated its own rules to fund government spending. On the surface, stability. Underneath, leverage. By the late 1600s, capital began drifting away. London rose next. Fast forward again, and you see the same cycle play out with Britain, then the United States. Different centuries, same structure. What makes the current moment unique isn't the debt alone. It's the speed, the scale, and the complacency. Modern financial systems are faster, more interconnected, and more leveraged than anything in history. That means transitions don't take 100 years anymore. They compress. And here's the part that makes people uncomfortable. Reserve currency status isn't permanent. It's earned, maintained, and eventually lost. Not because of evil plots or secret meetings, but because math always wins. This doesn't mean collapse happens tomorrow. It does mean we are further along the cycle than most people realize. The silent phase is never loud. By the time it becomes obvious, the exits are crowded. A little humor helps here because otherwise this all sounds like doom. Humans are incredible at innovation. Systems evolve, new centers rise, capital adapts. History isn't ending, it's rotating. The mistake people make is assuming they re-exempt from patterns just because the technology is newer or the buildings are taller. The goal isn't panic. Panic is expensive. The goal is awareness. Understanding where you are in the cycle changes how you think about risk, leverage, savings, and time. It shifts your focus from headlines to balance sheets. Every collapse in history felt impossible, right up until it wasn't. And every transition rewarded the people who paid attention early, not the ones who reacted loudly at the end. Money doesn't move emotionally, it moves mathematically. And right now, the math is speaking very clearly. The only real question is whether you're listening or whether you'll hear it later after the credits roll, wondering how you missed such an obvious plot twist. Long before newspapers admitted anything was wrong, the money had already packed its bags. You could see it in the ledgers if you knew where to look. Banking dynasties that had helped make Amsterdam rich began opening offices across the channel. Jewish merchant families who once dominated Dutch trade quietly relocated to London. Portuguese traders followed. German financiers didn't rush for the exits. They withdrew capital slowly, deliberately over years. No panic, no drama, just calculation. Why? Because insiders understood something the general public didn't and wouldn't for decades. The Bank of Amsterdam, the most trusted financial institution in Europe, had been insolvent since 1672. For years, it survived by using new deposits to cover old withdrawals. The mechanics were simple, familiar, and timeless. A Ponzi structure wrapped in respectability. As long as confidence held, the illusion survived. And for a while it did. But secrets like that don't age well. Eventually, reality insists on being acknowledged. When French revolutionary armies invaded in 1795, the Dutch Republic collapsed almost overnight. The guilder imploded. The fraud at the Bank of Amsterdam was exposed. Depositors were wiped out. Riots filled the streets. Political order disintegrated. A century and a half of dominance vanished in a matter of months. One generation went to bed living in the world's financial capital and woke up in a former one. And just like before, the money didn't disappear. It moved, this time to London. That brings us to the third example, and the most relevant one because it's close enough to modern memory that the parallels are uncomfortable. Britain didn't just dominate finance, it defined it. At its peak, the British Empire controlled nearly a quarter of the planet's population and land. The pound sterling served as the world's reserve currency for more than 2 centuries, longer than any modern currency ever has. London was the place. If you needed capital for a railroad, a mine, a port, or an entire government, London was where you went. More than 60% of global trade was settled in pounds. The gold standard revolved around sterling. British banks financed growth across every continent. It felt permanent. It felt earned. It felt inevitable. Then the 20th century arrived and reminded everyone that history doesn't care how impressive your resume looks. World War I shattered Britain's finances. The cost was staggering. Debt exploded from manageable levels to well over 100% of GDP. To keep the system alive, Britain borrowed from its own citizens, from foreign creditors, and increasingly from the United States. They tried to maintain the gold standard. They failed. They tried again. Failed again. Each attempt eroded confidence a little more. World War II finished the job. Britain emerged technically victorious, but financially exhausted. The empire still existed on maps, but economically it was hollowed out. Debt piled up. Money printing accelerated. promises outpaced reality, and then, quietly, the exodus began, not with speeches, with spreadsheets. British corporations didn't abandon the country, they redirected future investment elsewhere. Capital flowed toward America, wealthy families diversified abroad, talented scientists, engineers, entrepreneurs, and academics followed opportunity across the Atlantic. Britain offered high taxes and limited growth. America offered expansion and optimism. The choice didn't require patriotism or betrayal, just arithmetic. By the 1960s, foreign investment in Britain had collapsed. The writing was on the wall. In 1967, the pound was devalued more than 14% overnight. Imagine waking up to discover your currency simply shrank while you slept. Less than a decade later, Britain went to the International Monetary Fund for a bailout. The former financial center of the world was now asking for emergency loans. The pound lost its reserve currency status. Global trade shifted decisively to the dollar. Britain's era was over. 3 empires, 3 reserve currencies, same 4-stage cycle. Rise, overreach, quiet exit, collapse. No exceptions. Which brings us to now. In 1944, the Bretton Woods Agreement positioned the United States at the center of the global financial system. The dollar was tied to gold. Other currencies were tied to the dollar. America emerged from World War II with its industrial base intact, while Europe and Asia rebuilt. Capital flooded into U.S. markets. Stocks, bonds, real estate, treasuries. The dollar became the backbone of global trade. For a generation, the system worked remarkably well. Then, in 1971, the constraint disappeared. The U.S. ended gold convertibility. The dollar became a pure fiat currency backed by confidence alone. And once limits vanish, behavior changes. Spending expanded. Debt grew, at first slowly, then exponentially. What was once measured in billions became trillions, then tens of trillions. Government debt ballooned, corporate debt followed, household debt piled on, student loans, credit cards, auto loans, medical debt, layer upon layer. Total U.S. debt now exceeds $100 trillion, roughly 3.5 times the size of the economy itself. For perspective, Spain defaulted at far lower ratios. The Dutch system collapsed well below this level. Britain lost reserve status at about a third of where America stands today. Servicing the debt has become its own industry. The U.S. now spends over $1 trillion a year just on interest, not reducing the principal, just keeping the lights on. And the way that interest is paid tells the real story, by expanding the money supply, by monetizing debt, by printing. The results are predictable. Asset prices inflate together, housing surges. Stock valuations detach from underlying earnings. Wealth concentrates. Wages lag. The Federal Reserve balance sheet swells from under $1 trillion to nearly $9 trillion in little more than a decade. Stability is maintained, but only by adding more pressure beneath the surface. And then we arrive at the phase that never makes headlines while it's happening. The quiet rotation. Foreign holders of U.S. debt begin reducing exposure. China trims hundreds of billions in treasuries. Japan sells steadily, month after month. Middle Eastern and European holders diversify away. Even the Federal Reserve begins shrinking its own balance sheet, letting bonds mature without replacement. So who's buying the debt? Increasingly, the system itself. Government entities buying government obligations, circular financing. That's not confidence, that's necessity. Meanwhile, the largest financial institutions on Earth adjust their allocations. Less concentration in U.S. treasuries, more exposure to international infrastructure, commodities, real assets, emerging markets. Gold quietly re-enters portfolios. Diversification becomes the polite word for caution. No alarms, no declarations, just movement. This is how stage 3 always looks. Calm on the surface, activity underneath. And if history is any guide, stage 4 doesn't announce itself politely. It unfolds gradually, then accelerates. Reserve status erodes not with a single decision, but with many small ones. Trade settled in alternative currencies. Bilateral agreements bypassing the dollar. Systems built alongside the old one, then slowly replacing it. None of this means tomorrow morning looks dramatically different. Collapses are rarely cinematic in real time. They feel slow, confusing, and oddly boring until suddenly they're not. The purpose of understanding this cycle isn't fear, it's context. Patterns don't predict dates, but they do clarify direction. Every era believes it's different. Every empire assumes permanence. And every transition rewards those who pay attention before the crowd realizes the party is ending. Money doesn't panic, it migrates, quietly, logically. And it always leaves clues for anyone willing to stop scrolling long enough to notice. Something subtle is happening in global trade, and it's easy to miss if you're only watching headlines instead of flows. Countries that used to settle everything in dollars are quietly choosing alternatives. China and Brazil are trading directly in yuan. India and Russia are settling transactions in rupees. BRICS nations are building parallel payment systems designed specifically to function without the dollar in the middle. Taken together, these countries represent more than 40% of global GDP. That's not a fringe experiment. That's infrastructure being built for a different future. Now, let's clear up one piece of confusion that got a lot of attention last year. In mid-2024, headlines exploded claiming the petrodollar was dead. That wasn't exactly accurate, but it wasn't meaningless either. The 1974 U.S.-Saudi Economic Cooperation Agreement expired, and while there was never a formal written rule forcing Saudi Arabia to price oil only in dollars, there was a long-standing understanding. What matters isn't paperwork. What matters is behavior. And Saudi Arabia has openly signaled a willingness to accept other currencies, including yuan, for oil transactions. The practical impact is clear. The dollar's exclusive role in energy markets is weakening, not collapsing overnight, but loosening, which is how these things always start. Here's why that matters more than most people realize. For decades, global demand for dollars was artificially high because countries needed dollars to buy energy and trade. When that demand falls, all those dollars sitting in foreign central banks don't just vanish, they come back, they get sold, they flood the U.S. financial system. And when too many dollars chase the same goods, inflation doesn't gently rise, it accelerates. At that point, the Federal Reserve faces a choice that looks technical but is actually existential. Raise interest rates aggressively to crush inflation, which makes servicing tens of trillions in debt mathematically impossible and detonates the economy. Or keep printing and monetizing the debt, which destroys the currency's purchasing power. Different roads, same destination. Either way, liquidity dries up. Asset prices fall together instead of rotating. Stocks drop, bonds drop, real estate drops, banks wobble, pension funds strain. Insurance companies find themselves exposed. The cascade feeds on itself. And who absorbs the damage first? Not the institutions that moved early, the middle class, people whose savings, retirement accounts, and home equity are concentrated in dollar-based assets. This isn't a guess. It's the same outcome every time the cycle reaches this point. Now, whenever this comes up, there's a familiar objection. America is different, stronger military, better technology, world-class universities, the most innovative companies in history. Surely that changes the equation. History has already answered that argument. Spain had the most powerful military on earth in the 16th century. Didn't save its economy. The Dutch had the most advanced financial system ever seen in the 17th century. They invented modern markets. Didn't stop collapse. Britain ran the largest empire in history, led the Industrial Revolution, controlled global trade routes, and still lost reserve currency status. Military strength doesn't cancel debt math. Technology doesn't prevent currency debasement. Innovation can't overcome fiscal reality. Exceptionalism is comforting, but it's not a strategy. Another common belief is that central banks can simply print forever and avoid collapse. We've seen that movie too. Weimar Germany printed until money became wallpaper. Zimbabwe printed until trillion-dollar notes couldn't buy groceries. Venezuela printed until professionals fled and inflation reached levels that sound fictional. Argentina has reset its currency multiple times despite enormous natural wealth. Printing doesn't create prosperity. It redistributes it, quietly at first, from savers to debtors, from wage earners to asset holders, from the middle class to those closest to money creation. When confidence finally breaks, printing accelerates the fall instead of stopping it. Every empire believes its currency is permanent. Every reserve currency assumes it's the exception. None of them are. The pattern doesn't argue. It doesn't negotiate. It doesn't care about politics or optimism. It unfolds like gravity. And right now, by every historical and mathematical measure, the system is deep into stage 3. So what does that mean for someone listening to this today? Not as a theory, but as a practical reality? First, exposure matters. If most of your wealth is tied to dollar-denominated assets, you're not insulated, you're concentrated. Diversification is no longer a buzzword you hear from advisors trying to sound responsible. It's risk management in a system under stress. Assets that can't be created at will tend to hold value when currencies weaken. Gold has done that across civilizations for thousands of years. Silver, commodities, and real assets share similar properties. They're not perfect, but they don't rely on confidence in a single issuer. Second, geography matters more than people like to admit. Capital moves across borders for a reason. Spreading exposure across stable jurisdictions reduces political and currency risk. That doesn't mean abandoning your home country. It means acknowledging that concentration increases vulnerability. Currencies like the Swiss franc, Singapore dollar, or Norwegian krone exist precisely because stability has value. Third, timing matters. Stage 3 is not endless. Historically, it lasts somewhere between 18 and 36 months. Based on when foreign selling and institutional repositioning accelerated, we're likely well into that window. That doesn't mean panic tomorrow. It means preparation now. You don't need decades. You have months. Use them deliberately. Fourth, liquidity is underrated. Cash loses purchasing power over time, yes, but in a crisis, liquidity buys flexibility. It allows you to act when prices are falling and opportunities appear. Illiquid assets can trap you at exactly the wrong moment. The goal isn't to hold cash forever, it's to have options when volatility peaks. Fifth, debt becomes dangerous when rates rise structurally. High leverage feels manageable when money is cheap. It becomes suffocating when rates climb. Reducing variable rate or excessive debt isn't about fear, it's about resilience. Every percentage point increase compounds pressure. Sixth, invest in things no central bank can dilute. Skills, knowledge, relationships. Human capital survives every monetary reset. People who can solve problems, adapt quickly, and maintain trust don't get wiped out. They reposition. History is full of examples where wealth changed hands, but competence remained valuable. Seventh, stay informed without waiting for permission. By the time mainstream narratives fully shift, positioning opportunities are usually gone. Data moves before opinion. Capital moves before headlines. Understanding patterns gives you context instead of anxiety. This isn't about doom or drama. It's about pattern recognition. 500 years of financial history repeating the same cycle under different flags and currencies. America's debt didn't reach $38 trillion by accident. Foreign central banks aren't reducing exposure for fun. Major institutions aren't diversifying because they're bored. They're responding to the same signals that preceded every previous transition. We're in the capital flight phase, the quiet one, the one that only seems obvious in hindsight. Stage 4 always feels sudden, but it's built slowly. The pattern doesn't need belief. It doesn't require consensus. It doesn't wait for comfort. It unfolds whether people accept it or not. The people who come through these transitions intact aren't always the richest. They're the ones who saw it early, understood the mechanics, and acted with discipline instead of denial. The information is available. The data is public. The choice, as always, belongs to the individual.